Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Spencer Gray. Spencer is the founder and president of Gray Capital, which is an investment firm based in Indianapolis that specializes in value add multifamily properties in select Midwestern markets. Now, Spencer leads all strategic initiatives at the firm, including investment strategy, capital raising, and property operations. Now, guys, since founding Great Capital with his wife Alex, Spencer has been involved in over 2.5 billion in real estate transactions and currently controls over 750 million of multifamily real estate. And so, without further ado, I'd like to welcome our guest for today's show, Spencer Gray. My friend, welcome.
Hey, Kevin, really appreciate you having me on. I've been looking forward to being here.
Yeah, excited to have you. Excited to have you, and just dive into it. So, but I guess before we get into I guess the meat and potatoes of it all, and start going down that rabbit hole, let's just back it up a little bit. I gave you that brief introduction. I know there's a little more to your story. We talked about before we hit record. We talked about even your background, your family's background in farming, and you're one of the first in Indiana to start growing hops for the craft brew trade. And so, I know there's a lot more than that as well. So maybe take a few minutes for those who aren't familiar with you and your background, your story. Tell us a little bit more about who you are.
Yeah, no, I appreciate the opportunity. I mean, if I go all the way back, I kind of come from a family of entrepreneurs. Even talking to my father today, his father and his grandfather had started businesses, and some were successful, some weren't. By the time it got to my father, my grandfather was a successful real estate developer, single family homes back in the 50s. He was a naval aviator, got home, met his wife in Australia, brought her back. He started building houses. He eventually went bankrupt in the early 70s. And my dad saw, my grandfather lose absolutely everything. They had to move him out of their house into a small little apartment. And I think that kind of drove my father in a couple different ways, because he ended up being just a pure entrepreneur as well. He had done a lot of sales jobs, never really had like a stable career until he met my mother, and they got this crazy idea about selling tanning beds. This was like the early 80s, and this was like before anyone in the United States had really been using tanning beds. But he read something about in Europe, these weird, crazy things, crazy Europeans in Holland and Germany, they were using these tanning machines, tanning beds, lamps. He was able to raise enough money. He imported a shipping container of tanning beds from Germany, brought it over, sold the container himself, individual units, made incredible margins on this container of tanning beds. He turned around and he said, I need to hire an accountant because I don't know anything about accounting, and I'm going to hire a team of salespeople. I'm going to just pay them commission. They were living on a farm, little horse farm outside of Indianapolis, and he literally filled their little farmhouse with salespeople and an accountant, turned their barn into a warehouse, and started what eventually would become the world's largest manufacturer of tanning beds, and certainly the largest distributor in North America. Went on to create sunscreen brands, indoor tanning lotions. I'm familiar with the brand Australian Gold. Used to be a somewhat popular sunscreen brand, sold all over the world. Sold that business in 2005. So I grew up in an environment seeing that business being started, being founded, all of the challenges with that business, and to see them sell that business in 2005, which was really right before the great financial crisis, but also before tanning became a lot less popular. I mean, you don't see many tanning salons around today. All the tanning salons looks like they turned into CBD and vape shops is what I can tell, if you look at a retail strip center. But my dad was never really involved in real estate other than, kind of watching his dad. They owned a couple, buildings for their business, but really they didn't really know much about real estate. Mm-hmm. Parents retired. They eventually got divorced because they weren't really sure what to do with the money and really the time after selling this business. And it wasn't for about over a decade after that, I had started my own business in the hops industry that you had mentioned. I won't go into all the details of that. It was a really fun career, fun business. I started getting into multifamily real estate. I had flipped single family homes all the way back in 2006. Mm-hmm. I always liked real estate, but it wasn't my full-time, my strongest passion at the time. sold the hops business. I said, what are we going to do now? I'm going to start a new business. I love real estate. I was pouring into like the Bigger Pockets forums. I was reading every real estate book I could get my hands on. And I just fell in love with this concept of buy and hold multifamily investing, specifically value add multifamily investing. So I was networking with lenders, investors, syndicators, anyone that would really, have a lunch with me. And I had a conversation with a lender that essentially said, what you want, you can't do what you're setting out to do because you don't qualify for the loans to get these properties. Even if you can raise the money, you're not going to be able to qualify for the loans. So he said, what you want to do is partner with someone who has enough experience. You help them, you sign on the loan, and you can start gaining a track record and experience. So that's essentially what my wife and I did. This was back in like 2014, 2015. We started investing as a co-general partner with another syndicator based out of Indianapolis, doing due diligence, doing asset selection, doing asset management, raising some capital on the side, in addition to investing our own money into the deals. Until we had enough of experience, we did well over a dozen co-GP investments with that individual syndicator until we started doing our own sponsored deals in about 2019, which that's what we've done, solely just our own lead sponsor deals kind of since that 2019 era. We founded our own property management company in that time as well. And we now currently manage about 2,300 units and have a portfolio comprised of our core portfolio, a co-G portfolio, and LP portfolio of about 7,500 units.
Gotcha. No, great story. Appreciate all the additional insight. I want to hit on a point that I think might be relevant to folks that are kind of tuning in that are maybe just getting started, trying to go down that path. You had that conversation with, I think you said it was a broker that ultimately, showed you one of the barriers you're going to have to overcome. And that was just, having the, a strength of a balance sheet, but not just that, but also the experience in the, lender's eyes, that you knew what you were doing would ultimately be able to qualify for these loans. And even if you could raise the capital, right, like they're going to look at your personal balance sheet, and they're also going to look at your track record, and you just didn't have. It sounds like you might not have had either, right, or a little bit of each, right?
Yeah, I really definitely did not have the track record and didn't have enough of a balance sheet. We were getting close. We'd sold a business, but it wasn't really enough to do the deals that we wanted to do.
So how do you? I guess. What value proposition, what was the value proposition that you brought to I think you had referenced, there's another syndicator in the Indianapolis marketplace. I'm going to make the assumption, correct me if I'm wrong, that maybe they had been doing it for quite a number of years. They already had the track record. Obviously, they had the experience to be able to go get the loans on behalf of that business. And so I guess what was the value proposition that you could bring to the table, as far as from experience, maybe bring some, you said you'd help raise some capital, things like that. But just what was that sales pitch like?
Yeah, well, they were, I think we caught each other at the right time, to be honest. They had enough of a track record and enough experience to be able to, qualify for the loans themselves, to win the deals. But they needed a little bit of help. They needed help on the balance sheet side, so they couldn't themselves qualify for these loans. They could from a track record and experience, but their balance sheet wasn't sufficient enough to be able to provide the guarantees to be able to secure the loans, because you have to have, a certain amount of net worth, and then you also have a certain amount of liquidity, liquid securities or cash available that the lender wants to see that, you have the collateral that they can feel secure enough in issuing you that loan. So not only were we be able to come in and assist with adding our balance sheet to kind of the guarantor pool that the lender is going to take a look at, we were also going to be writing a check for the investment itself that moved the needle. So it helped them get the deal, the capital raise completed. It allowed them to secure the loan. And then also, we weren't just talking about one deal. We wanted to start, a business and essentially do what they wanted. We wanted to do what they were doing at the time. Mm-hmm. And we were transparent and upfront and say, hey, look, we want to do our own deals eventually, but we're not there yet. So, we'll participate, we'll sign on some of these loans, but we want to be right in the driver's seat along with you. We want to be doing the asset management. We want to be doing the site selection, due diligence. We want to be involved in the entire process. and we're going to do multiple deals together. Now, it's not going to last forever. At some point, we're going to go off on our own and do our own deals. But we've got a good runway here before we feel comfortable, and not just to get the bare minimum track record to go do the deals, but we wanted to gain the experience of understanding and learning the process, and not just learning about it, but actually doing it. I mean, I'd read all the books at that point. I knew practically what the steps were. How to negotiate how to write an LOI, how to negotiate a PSA, the steps to do due diligence before you close on a property. And once you close, how do you conduct asset management? But I never actually done all of those things for a large multifamily property. And so I wanted to be in the passenger seat with them, do that alongside a firm that I trusted, that I thought did a really good job, to be able to learn to do it ourselves. And that's exactly what we did several years later, and a couple thousand units later as well.
Yeah, no, fantastic. Appreciate that. So I know you're based in Indy, but a lot of folks will say like you don't necessarily have to invest in your backyard, right? I do think invest in your backyard. If you live in if you have a great backyard, and the economics are strong, then invest in your backyard. It's a great thing. You could be close to the assets and just have your finger on the pulse, more of the day to day, or just the oversight, from an asset management perspective. But a lot of folks also, like, including myself, I live down in the Tampa, Florida area, and while we have some investments here locally, both in Tampa Bay as well as just Florida in general, we've got stuff that spans like 13 states, right? And so it's not even remotely in my backyard. In fact, some of them take a 3 or 4 hour flight to get to, which creates, some benefits and drawbacks, right? But so I guess the question being, what was the emphasis, or catalyst to really push you guys to, not just in the beginning, but even today? It seems like you mostly focus, with the exception maybe a few assets, in the Indy and immediate surrounding markets. Just what do you love about the marketplace? What are some of those economic tailwinds that you see that will ultimately carry this market forward for many years to come?
Yeah, well, definitely, I can get into some of the drivers behind the Midwest and why we're continuing to invest in the Midwest. But first, the first part of your question of investing your backyard versus investing just the best markets to invest in. How did we decide to choose to? How do we choose to invest in our backyard? And it was an evolution. First of all, it was just, what do we know? Let's take a look at in our backyard. We want to be able to drive there. We want to be able to, see the properties physically, go on site. And doing that, that's close to home is just, frankly, it's easier to get started. Now, some investors, especially if you're living on the coasts or in other markets, where the real estate is priced to where just the deals don't pencil, that can be really frustrating, and you're really forced to go out into a different market. And I'll tell anybody this, regardless of the specific strategy. Once you have identified that strategy, pick the best market, pick the asset that fits your goals and objectives. Don't just find something that you can buy because it's there and it exists. It needs to check all of your boxes. Mm-hmm. Through our analysis, we found that Indianapolis and many Midwestern markets do check our boxes, because we were looking for cash flow and moderate appreciation. And the Midwest typically has slightly higher cap rates compared to the national average that can translate into higher levels of cash on cash returns and yield. Whereas a market like, say, in California or New York or somewhere else that's kind of high price, maybe getting less cash flow, most of your return is going to come from the capital gains. And when you sell the property or refinance the property, so just your component of your return is made up slightly differently. For a while though, we asked ourselves, should we invest in the Sun Belt? Should we invest in some of these higher growth markets that are growing much faster than the markets that we're in the Midwest? But the conclusion that we came to is that we're market experts for like a city like Indianapolis, in the surrounding markets in Indiana. We know the brokers, we know the players, we know the industries, and I could go to another market that has a higher population growth rate, but I'm not going to know all of the intricacies, and I don't know what I don't know about those markets. And so at first it was, we want to be able to quantify that risk and not take a lot of unnecessary risk by going into a market where we just don't know everything that we don't know. And then as it's turned out, the Midwest has become even more attractive over the last several years. One, because the Midwest gets often ignored by other investors. So much attention has been on the Sun Belt, from retail investors, especially over the last 10 years, driven by demographics. A lot of people are moving to the Sun Belt. But what happened is investors from the coast and elsewhere saw those demographic signals, and everyone decided, hey, let's invest and let's build in the same few markets and the same few submarkets. So we've seen a dramatic increase of supply, kind of a 40-year peak of new supply, which, while there can be population growth, if you have 1,000 people moving in to a market, that's great. But if you deliver 5,000 new apartments, you've got too much supply and not enough demand. And that's what many Southern and Sunbelt markets are dealing with right now, where the Midwest, it's flyover country, right? It's like people, it's cornfields, it's flat, it's often forgotten about. And so people didn't invest as much. They didn't develop. But what ended up happening is, as more manufacturing jobs started coming back to the Midwest, we have stable employment, we have stable industries, and so we have robust economic activity, but not as much supply coming in. So the net result is more consistent growth and generally just a less volatile investment environment.
Yeah, no, and it's interesting because we've actually got our portfolio. It's kind of spread out among Sunbelt states, but the other half is in select Midwestern markets, and we've had just a great experience over the last decade with the investments that we've had there. A little bit more steady growth, not as many peaks and valleys, but again, it's steady eddy performers, consistent demand for the product, and just slow, consistent population growth. I mean, like, it's just in the biggest piece that you've already mentioned, less competition, right? Like, typically we're buying things at slightly higher cap rates than what would be the going rate for something in the Sunbelt market. But I've also found that, at least in our industry, in the mobile home park space, that the actual assets are of higher quality. So you're buying things at a higher cap rate, and they're slightly higher quality than the comparative property that you might buy in one of the Sun Belt states. So we've had a great experience with it. Intend to continue investing in a number of different Midwestern states and marketplaces. So, you'd mentioned in the beginning. I think you'd referenced that at some point you launched a property management division. I'm assuming in the beginning that was it the case that you'd essentially hand this off to a third party management company, and at some point you guys saw a pivotal opportunity to bring it in house, or how'd that all play out?
Yeah, we never wanted to really do property management.
Who
The whole
does?
idea of, headache, just headaches, tenants and toilets, like, no,
Yeah.
the idea of, passive income. You're sitting back, you're relaxing, you let the checks come in, and, that can be true. You can make an LP investment and that passive income comes in, and that's awesome. But I'm an entrepreneur. I'm a hands-on individual, and at first we could only take on so much. We don't want to bite off more than we can chew. And property management is a completely different business than investing and syndicating and capital raising. It's different customers, it's different systems, but at the core, it's what our business is. It's what our business eventually is all about. Is we can, put together a great deal, but if we're essentially outsourcing the operations and the execution, I mean, you can manage the manager and manage the process, but at the end of the day, it wasn't our people, it wasn't our systems, it wasn't our policies that were going on at the sites themselves. So we started third-party management, and then eventually, in about 2022, we decided we were at a scale where we could start bringing things in-house, and it was partially just a lack of control, a little bit of lack of transparency, the appearance of filters was going through a regional property manager to the property manager down to the leasing team. The information that we were receiving, just goes through several different filters and checks. And so by the time it gets to our asset management team and the ownership group, Has it been padded? Has the information been kind of curated to make it look like things are, going pretty well?
Yeah.
And there's never going to be necessarily the criticism in those reports of maybe the property management systems themselves. And so we said, if we really want to truly control these business plans and how we execute and put our own mark on it, because part of the realization, we looked around and we said, property management today isn't that great. Like, your average resident experience is below average. If you talk to somebody who's rented an apartment in the last couple of years, very few cases are that, oh, it was smooth the entire time, the communication was good, it was a great experience. And part of that is the just the teams and the employment pool that we have that we're hiring from. Typically, like leasing consultants, they're folks that basically decided not to work a retail job and they're working in, apartment leasing. And so they're not necessarily salespeople. They're people who are, basically helping somebody through the process, which sometimes that's okay. But again, it's like, we want to be selling apartments. You're selling a product that is worth an annual cost is worth more than any people's cars. We're talking, $1,000, monthly rent. That's just $12,000. We have apartments that rent for $3,000. That's it's $36,000 pay of rental payments that year. But we're treating it like you're renting a car versus you're buying a car, and you're not really providing that customer experience that people are looking for, because everyone is looking for high quality experiences today. They're not necessarily looking for stuff. They want a good quality experience. And so the only way that we could make that happen on our sites was that if we did it ourselves. Because I can't tell a third party property manager, I've got a new script for your sales team. We've got a new policies for your employees, because they're their employees, they're not our employees.
What do you think that's really? And I agree with that. That's a great analogy, that you really are selling a very expensive product or service. On the low end, $12,000 a year. On the high end could be $36,000, $48,000, $60,000 a year, depending on the type of product that you have. Do you think it's a function? I guess just speaking to any in generalities about a lot of third-party management companies. I know they don't all operate underneath this framework, but to where they just basically, you pluck someone out of the retail environment. They don't want to be working at Abercrombie anymore in the mall, and so like they want to try a new career path out, and ultimately they land themselves in a leasing environment, a leasing agent environment, not necessarily formally trained, has never sold a high-end product. Is it a function of just the thin margins in the property management space in general? Because I mean, it's not a overly profitable business. It's tough to make good money. And, you mentioned, we'll hit on this. You mentioned there was a point in time where you felt you had enough scale to bring it back in house, and scale represents top line revenue to justify the expenses associated with building out a property management infrastructure. But do you think that's just a part of it, where they kind of they go for the lower tier talent because it's in their mind it's short sighted, it's cheaper though, right? Like because they're operating underneath such thin margins. Is that it?
I think it's I think that's part of it, is that, look, we only have so much money to hire. We only have so much salary, so much payroll to hire. So we need to hire someone that we're paying $22, $25 an hour, and maybe we're going to give them a little bit of a commission when they sign a lease. But we're talking, they're earning maybe $25 a lease or $50 a lease, versus, again, someone who's selling a higher end product whose commission is going to be significantly higher. So a lot of it, I think, is the mindset of the way we've been doing property management for the last several decades is not the way we can do property management over the next decade. Part of it comes down to the workforce. We're just not getting the amount of real work hours out of our employees generally that we used to be able to get 10 or 15 years ago. And people are also leasing apartments in a different way than they did 10 or 15 years ago. It's not like everyone needs to come into the apartment to lease the apartment themselves. We do so much leasing, online. People are doing virtual tours. They can fill out their entire application on the internet before they've even seen the property. And so when we look at, how many people we have on site and what they're actually, if we break down what they're doing on a per hour basis, and we look at how many inbound leads we have coming into each site, how much follow-up, how many physical tours, we come to the conclusion is that we have a lot of wasted man hours, especially in terms of leasing. And so like for a 250 unit community, oftentimes there will be at least two leasing consultants, in addition to, an assistant manager, a property manager, and a team of on-site maintenance personnel. If you're only doing 4 to 5 physical in-person tours a week, do you need 2 people on site full time to do those tours? I really don't think so. In fact, one person can be handling follow-up, outbound, across multiple sites. And so part of what we've been working on over the last couple of years is, can we rethink how these properties are operated and managed? What has to be done on site, and what can be done from a centralized facility, can be done from somebody that's working remotely from home across multiple sites, so we can reduce the overall actually number of people that are working on site. The people that are, we can compensate them more fairly, pay them more money. And so we can pay, instead of what we call an order taker, someone who just takes someone who's looking for an apartment, you want a one bed, one bath, here you go, to actual salespeople who can really truly follow up, understand what a sales cycle is, close prospective leads, and sign leases, but then pay them a healthy commission because they're doing that work and they're actually making a difference at the property. And again, all of that we can only do if we're running the property management operations.
Yeah.
If we're third party. Now, other companies, we're not the only ones that are doing this. This has been a trend in property management for the last several years. But I want to make sure that we're setting ourselves up for the next decade or two, rather than hoping our third party property manager is doing all the right things.
Well, I think it's also, you being able to take full accountability of everything good and everything bad that happens inside your properties, right? Like I would much rather, if I've got to give bad news to an investor about the, monthly, quarterly, or annual performance of a particular asset, although it's bad news and it's hard to provide either way, I'd rather know that I own it. We understand, we identify the problem, and here's the multiple solutions, rather than just passing it off and not having control over what those solutions might look like. Passing off, saying third party property management company sucks, it's a horrific experience, we're going to move to a different one. But that's not a good solution, right? Because it doesn't. How is the next company? Number one, the transition period is going to be horrific. The property is going to suffer during that time frame. And who's to say that this next property management company, they've sold you, they've sold you how great they are and how they're going to do things different. But you still can't own the mistake. You can't own the problem. You can't own the solution. The only way that you could fully own it full cycle is if you've got it in house, right? So I don't know. There's something about that, and we're vertically integrated as well. We have been for many years, and it's a direct result of experiences that we had years past, just like you had, right? Like just not being able to be fully in control and manage that life cycle from beginning to end and own it entirely. So, and it's not a sexy business, and it's not a overly profitable business, and there's a very significant infrastructure, team members. I mean, it's the largest part of our organization, and it's got the thinnest margins. So, but it's a necessary. I don't like to call it a necessary evil, because that sounds derogatory, but it is. Yeah. It's one of those. It's a necessity business. There's three. We always like to say internally, there's 3 legs of the overall stool, at least in our business, right? You got to find the property, you got to fund the property, but then you got to operate it, right? And if you lose control of any one of those stools, well, guess what? You don't really have an investment at that point in time. I mean, it's more speculative than anything else. So
no, so true. And what you said about accountability really resonates, because at the end of the day, you have your own property management company. You're using a third party. And again, there's great third party property management companies out there. I'm not saying there aren't. But at the end of the day, if you have investors, you've raised money from individuals, you're responsible at the end of the day for delivering results. You're responsible for hiring the best property manager, for screening them, and for managing that property manager. And a lot of investors, sponsors, syndicators, they think of those first 2 stools that you mentioned, the finding the deal and putting the money together. They're not thinking about the actual operations. And again, great operating partners. You partner with a good operating partner, you can have that third leg of the stool. But at the end of the day, it's going to be we're accountable, for
Yeah.
the results, and want to be able to control, where the actual rubber meets the road to get there.
And I will say that I know that it's a little more difficult of a capital raising environment, but I still believe that raising the capital and finding a deal are really the two easiest elements of this entire business. And like, none of it's easy, but operations is tough. To do it right, it's incredibly tough.
Yeah.
And anyway, so just because you could find you could find the greatest opportunity in the world. You could raise the capital for it, one that's it's got an incredible yield on paper. I mean, it's the best market ever. You're stealing at a wonderful basis, but if you suck at the operations side, ultimately you could still lose money on that deal. Even if you bought it at literally a 50% basis of real world value, like you could still lose money on that deal. So operations is so critically important.
Absolutely.
Shifting the conversation, I want to be respectful of your time as well and try to keep this, somewhat to the time frame I'd promised you. I guess how I'd like to round this show out is, you've been in this business for quite a number of years now. You've looked at a lot. You've gone full cycle on a lot of deals. You guys have acquired a lot. You've in order to actually even do the deals you've done, you've looked at hundreds, if not thousands, of them, right? And
Yeah.
some go good, some go bad, and then some are just horrific. The ones that literally stress you out to the nth degree, make you lose sleep, just add just a ridiculous amount of undue stress to your life. And so I would love to know. I'm sure there's multiple deals that come to mind, but the one that comes top of mind, the one that just created the most strife in your life, what kind of deal was it? What were the challenges associated with it? And then ultimately, what was the outcome? And this could be something that you either got under contract, went through due diligence, and many red flags popped up and you passed on it, or one that you actually closed on that, had operational challenges or any other type of challenges that just, again, it was outside of the norm.
Yeah. No, I mean, we've got a lot of good amount of success stories, but every single one of those success stories, inside of it, there's another story of a challenge, because none of it was easy. We've had plenty of deals that have not gone exactly the way that we thought they were going to go at first. One of our earlier on, one of the first deals that we were the lead sponsor on. This was in 2020, so like right in the heart of the pandemic. Everything was closed down. We went under contract to buy a 36-unit fractured condo community in Indianapolis. So there were 36 units. 24 of those units were owned by a single owner, who's the seller. 12 of the units were owned by individuals. We were able to consolidate all of the units before we actually closed. So we did one simultaneous closing, bought all 36 units. What we didn't realize is the previous owners had made some of the residents so mad through poor property management that there was an exodus the day after we closed. And we went from being 90% occupied down to 46% occupied over several weeks.
Wow.
So we went from thinking we were having a cash flowing deal, because of course their leases didn't have any lease breakage fees. They're poor. They weren't the leases that we would sign. We thought we bought a cash flowing asset. It went from, we had negative cash flow essentially out of the gate. We had to do large renovation. The property hadn't really had the CapEx done to it. The preventive maintenance wasn't being done. It was a newer property, relatively nice, but it just had been slipping for the last 10 years. So, I mean, we went several months of, getting this property, fixing it up. But then the units themselves, they were massive units. So I think they were 2,600 square feet, really large floor plans. Because they were originally built as condos, custom condos. So, really nice granite, custom kitchens, oversized kitchens, beautiful bathrooms, like really, really nice finishes. We were trying to lease these out anywhere between kind of $2,700 and $3,600. So a true like premium, like luxury, like rental. There was demand, but we just weren't getting traction. And at the time, we weren't doing our own property management. We had a third party that was managing it, and they really just didn't fully understand the concept of what we were trying to do. They were much better suited at leasing traditional apartment units that would lease for 1,000 or 1,200 units a month, $1,200 a month. They just didn't know what to do with something that we were trying to lease for over $3,000 a month, because it was just a different product type. We went months without signing a single lease.
Wow.
And so we're in the middle of this, and I have to start putting money into the deal. I don't want to issue a capital call at the beginning because like I just didn't want to get to that point yet.
Sure.
So I start contributing just as a non-interest paying member loan. I start putting money into the deal to basically float us to get some leases. We're able to complete the renovation. We finally start getting leases. Eventually, we were able to get the entire property leased up. We were able to get to 100% occupancy. Sold the property after just 18 months of ownership for, I think, a 48% IRR and a 2x multiple under 2 years, but only because we were able to thread the needle, get the property completely leased up, and finally figure out we ended up having to take over the construction management of the property. We didn't take over property management just because we weren't really tooled to be able to do that. But we learned a lesson that if we want to have something done the right way, we have to do some of it ourselves.
Hmm.
And we need to make sure that our property management partner, in that case, really understood what the business plan is. And we needed to make sure that they were actually capable of executing and not just asking if they're comfortable, but really looking at their track record and seeing if they've done it before. We didn't start property management up right after that experience. We just didn't have the scale to, but it was one of the it was one of the reasons why about a year and a half later we did start our own property
Yeah.
management company.
Yeah, no, that's a great story. Lots of lessons there. I think in one little takeaway that I would just summarize for those that are listening. I mean, if you're an LP out there looking for, trying to vet sponsors and find a group that's got the track record and it's a lot to filter out. It really is to do appropriate due diligence on a sponsor and make a decision with your hard-earned money of who are you going to invest with. To your point, being having cash and having a strong enough balance sheet on hand to actually, problems arise, things happen, nothing ever goes as laid out on a pro forma. It either exceeds or it doesn't meet the pro forma, one of the two,
Hmm.
right? You never hit on the mark. But you were in a strong enough financial position where you're able to partially, fund, kind of carry it along,
Yeah.
without having to go back to your investors or your LPs and do a capital call. And so I think a lot of what's kind of transpired over the last couple of years, with rates going up faster than anyone anticipated. Surely there's a lot of even really good sponsors that had a strong balance sheet that still found themselves in trouble just because they had a lot of projects.
Yeah.
But I think there's probably equal amounts of sponsors that found themselves in situations where like they literally had their personal financial situation was barely good enough to do it, and they didn't have a good strong balance sheet. They didn't have a plan B to carry them through a temporary lull. So I think that's just one thing. And not that you don't necessarily ask a sponsor for their personal balance sheet or for the company balance sheet, but you surely could, right? Like just if you have
Yeah.
whatever you need to do to get a firm understanding of what type of financial strength they have in the event of a situation like this. Because again, we've had many deals that have exceeded expectations, and we've had a few that just have not, right? And hopefully it all
Yep.
balances out in the long run. But the ones like this are the one that you learn a lot from, but they give you a lot of additional gray hairs. And man, they're just it's one challenge after another. But it sounds like in the end of the day, you guys kicked ass on that one. I mean, what a great return in a short period of time. Like you got the ship righted and rode off into the sunset. So, but that's a great story. I appreciate you sharing that and being vulnerable. And it's tough to talk about the challenging ones because the last thing you want to do is rehash it. Especially when you're in the trenches. It's like it's never ending, right? Like
Oh,
one
yeah.
day one day feels like a week or a year, right? It just keeps going,
Yeah.
going. And
And there's always one. I find in our, there's always one. We call it, what's the kind of the dog in our portfolio? There's always one deal that just isn't doing what it should be doing. And hopefully you only have one of those and it's not
yeah,
that big of a deal instead of, your whole portfolio. But it's through that adversity that you do learn a lot. You build muscle and, like I have so many stories that maybe weren't that
yeah.
bad, but, but the end result was I got better or the company got so much better because we built new systems, new processes. And so when we approach a similar problem, we've got the playbook to know how to tackle it.
Hmm. Yeah, well, fantastic. Well, Spencer, appreciate you coming on, my friend. It's been a pleasure having you. Yeah, for those that would like to learn more about you and your firm, where's the best place to track you down?
Probably two best places. One, I'm pretty active on LinkedIn, so if you want to connect with me on LinkedIn, we drop content pretty regularly. We've got a YouTube show that we do once a week that you can check out. It's called The Gray Report. Cover all kinds of market research and data. But our website's graycapitalllc.com if people want to check that out as well.
Awesome. Well, Spencer, my friend, again, appreciate you coming to the show. It's been a pleasure having you.
Hey, thanks, Kevin. Really appreciate it.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.